invest or overpay your mortgage? I know what I'm doing, and by the end of this video, so should you. So you've got a mortgage and some investments. You've watched some videos about whether you should use your investments to reduce your mortgage or continue building your pot, but still feel something is missing from the arguments. You're not alone. Today I'm sharing my framework for this decision and showing you what changes I'm personally making. So stick around. Point 1. The mathematics. Investing usually wins. Interest on your mortgage is a guaranteed rate working against you, say 4%. Meanwhile, the stock market historically returns around 7% over the long run. So purely by the numbers, investing should grow your money at a greater pace than the interest on your mortgage. Easy, right? Just invest and watch your wealth multiply. However, it's not that simple. This is the annual price of the S&P 500 for nearly the last 100 years, presented in the usual way to make you go, easy, no-brainer, I'll just buy that. Sure, there are some dips, but look at the rocket just take off. Now this is the chart with a slightly different scale on the y-axis that I feel adds better context. I found this at macrotrends.net, and a link to this page is in the description below. If you invested in 1929, you would have to wait until 1954 to get your money back, and that's without any inflation. You can see there are many regions where investing for over a decade would lead to hardly any growth, or even a small loss. The 25-year period of 1959 to 1984 gives a 4.2% average annual return. I don't think anyone would be yelling, I wish I'd invested more in the stock market during this period. 25 years is what a normal mortgage duration used to be, so that is not an insignificant time frame for those two examples. We've had some recent blips in the market, and the speed of the market recovery has been incredible. 2020 had a sharp drop with an almost as sharp recovery. The tariff issues in 2025 caused significant drops that were recovered from within a quarter. If you had significant investments during the bottom of these dips, I don't suppose you felt great at the time, but my concern is these rapid recovery periods are what people expect to be the norm going forward. So ask yourself, how did you feel during these times? How would you have felt if those losses persisted for years or even decades? Many other factors muddy the waters that we haven't even touched on. GBP to USD exchange rate, inflation, interest rates, those all play a role, and we'll be covering those in future videos. Point 2. The reality, uncertainty and stress. So the headline average investment returns seem steady at 7%. It's certainly not raising any red flags of, that sounds a bit get rich quick to me, but as we've just shown, the noise generating that average is significant. Meanwhile, your mortgage still needs paying every month like clockwork. For many, that stress of what if the market crashes is worth more than the extra money maths theoretically promises. Paying off your mortgage early means no monthly interest, no worries about market crashes, and a guaranteed return equal to your mortgage rate. It's boring, but your brain and sleep pattern may thank you. Point 3. It's not all or nothing. Find your balance. You don't have to be an all-or-nothing investor or mortgage crusher. Splitting extra cash between paying down your mortgage and investing can get you some growth and peace of mind. Many factors come into play, so consider your personal situation, income security, risk tolerance, and how much losing money affects you psychologically. Sometimes, peace of mind trumps a couple of theoretical percentage points. Where your investments are matters too. If it's in a special tax wrapper such as an ISA, know that it will potentially take many years to build that balance back up. Point 4. What am I doing and what should you do? What I have done is looked at those decision factors, financial, personal, and psychological. I have scored each factor as to whether it leans towards investing or overpaying my mortgage. My personal responses to each of these factors are showing on screen now. For me personally, I have a good financial base, so all the numbers are pointing towards investing instead of overpaying. However, my psychological answers show that I would benefit from reducing my mortgage balance. So in our household, we are making a change. Currently, we put all our spare cash into our stocks and shares ISAs. Going forward, we will carry on investing in our ISAs, but the majority, 75% of our spare cash, will be going towards mortgage overpayments. We feel that split will give us the psychological safety needed while still inching up our ISA balances. Do this exercise for yourself, and see which side of the coin the majority of your answers fall. The answers may surprise you. Either way, it will give you confidence that you are doing the right thing for you and not for someone else. So as a recap, when the gurus say investing usually wins, is usually good enough for you? Is the appeal of paying off your mortgage more enticing? Or do you want to float somewhere in between and find a balance that works for you? I hope this video gave you a new perspective on the dilemma. If you liked this no-nonsense take on overpaying versus investing, hit like, subscribe, and drop your thoughts below on your approach. Bonus points for mentioning any other factors you'll be considering that I haven't mentioned.